Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome back to another episode of the ASB Investment Podcast. I'm your host, Nigel Grant. Today, we have the absolute pleasure of having our friends from Harbour Asset Management in the studio today with us. Harbour is an underlying fund manager we use in some of our portfolios, especially for Australasian equities and NZ corporate bonds. Harbour put out their thoughts on the top 10 risks and opportunities for 2025 just before the summer break. It's where their research team debates the issues that might surprise markets in the year ahead and perhaps beyond. Now, I read this over the summer break, as one does, while I wasn't reading while gardening, but I was in my gardening phase. And I remember instantly going, we have got to have the Harbour team on to talk about it. I genuinely did that and then emailed the team, we're going to make it happen. So with that, it's a very warm welcome to Chris Wilson and Chris Di Leva. How are you both?
Very well, thank you, Nigel. Very well.
Great to be here.
And firstly, can you give our listeners a bit of an insight into your roles at Harbour? We'll start with you, Chris Wilson, and you can pass the mic after that.
Thanks, Nigel. Look, I've recently joined Harbour actually as co-CEO with alongside Andrew Baskand. So, interesting enough, I've been with Harbour for 6 months, but the relationship with Harbour goes back actually quite a long time. So, basically as long as the relationship ASB's had with Harbour. So, been sort of 15 years plus knowing the business and the 15 years of Harbour's existence. And so great now to be part of the team, leading the business and, involved with the strategy and direction of, where we're taking Harbour, moving forward.
And other Chris, what your role is?
Yes, so I'm the head of global and multi-asset investments at Harbour, so responsible for the diversified funds offering and global funds that we offer to investors. So day-to-day, tactical asset allocation, strategic asset allocation is kind of key part of my role.
Sure. Just take a pause. Do you go on ZV as well?
Yeah.
Yeah, I know the voice now. I love the Sunday. Yeah.
Oh, yeah. Smart money. Yeah.
Smart money.
Yeah, I know that. I was like, gosh, that is a velvet voice. And my dad actually always texts me at about 4:30, I think it is, and goes, Sunday money's coming up.
Yeah.
So there you go. So I reckon. So I knew the dulcet tones. Okay. Well, we're going to do. I think we'll because we've got two Chris's in. We'll do a bit of a contest at the end, just to see who the superior Chris is at the end of it. Who's the Chris 1 and who's the Chris 2? Let's go to the first topic, the lay of the land, and look at where we are now. So there were a number of themes, obviously, in your write-up, and we'll look today to focus on a few of the key ones. To begin with, you mentioned the importance of understanding where we are now, particularly when we consider the outcomes of your top risks and opportunities from last year. Can you paint the picture for our listeners, I guess, with a particular focus on some of the lessons you and the team learned from 2024, and did they play out as expected? And I think, Chris Di Leva, we're going to you first on this one.
Yeah, no, I'm happy to cover that one as Chris 1. Look, every year when we sit down to write these, it's a tall order because, we often can overestimate short-term change and, as a result, sometimes themes can play out over longer. What was really quite astounding last year was just the speed and adoption of AI and how that translated into company earnings. So if you actually look at the US market, last year we thought that earnings expectations were actually quite high given where the US was in its economic cycle. As that turned out, we're actually completely wrong. The Magnificent Seven or really large technology companies, the earnings growth that they were able to deliver really powered the market forward. So we had a really strong earnings-led market. And there's a double whammy when that happens. Because when earnings are strong, people are happy to pay more for a company. Mm-hmm. But that makes it a little bit harder this year because we've got to a point where valuations by most metrics are really quite high for global markets. So as a starting point, high valuations don't actually, again, tell you a lot over the next 12 months, but they're quite a limiting factor as we look forward a little bit further. So I think that was the key trend that we underestimated. Inflation actually moderated reasonably well. I think the last mile of inflation is proving to be a little bit stickier and more stubborn than people thought. But, again, if you look back to 2022 and, someone said to you at the end of 2024, kind of US inflation is going to be around 3%, you'd have taken that every day of the week, right?
Yeah.
We're staring at 7-8% inflation. The lines at the ports for ships was just so long. You couldn't get your hand on your favourite type of kitchenware. You had to wait for it to come. So, look, all that COVID noise has actually taken a long time to work its way through the system. So I think actually 2025 is actually a pretty clean year as far as the COVID overhang goes. So a lot of the supply chain issues, they're sorted out. A lot of the associated impacts on inflation, but also all the associated impacts on earnings for particular companies that might have over or under earned during COVID have sorted themselves out as well. So I think as a starting point for markets, even though valuations are quite high relative to history, I still think the fundamental grounding for markets going into 2025 is still pretty good.
And you talked, I think, a little bit about bonds, the extent that bonds can behave as a bit of a portfolio diversifier. Would you have any sort of more thoughts on expanding on that and what you meant by that?
Yeah, so if you look in the rear view mirror, bonds look terrible.
Over what sort of period?
So over the last 10 years.
Yeah.
Particularly in 2022, you had this really rare scenario, which is an incredibly rare scenario. I think we've got the data, and it's something like 3 times over the past 60 bonds and equities have fallen in the same year.
Yeah.
But 2 of those occurrences in New Zealand actually happened 2 years in a row.
Yeah.
We really wanted to draw that out as a theme because if you look in the rearview mirror, you just wouldn't invest in bonds. But that ignores the fact that bonds are a great portfolio diversifier for a growth shock, not an inflation shock.
Yeah.
Okay, so they're also trading at a yield where they can offer you protection. So as you know, when you hold a bond, you can get your return in 2 ways. One, you get it from collecting the coupon.
Yep.
Secondly, you get it from any priced returns. So, if yields fall, someone will pay you more for your bond.
Yep.
Now, that concept now actually means you have the yield, right? So you're getting a decent yield, but also there's space for bond yields to fall because they're actually at 4 or 5% in most developed economies at the moment. So I think that is really important, and that is so different to say where we got to in 2020. How much of a diversifier could bonds have really been at those incredibly low yields?
Yeah.
Sure, back then, actually 0 wasn't the lower bound. You recall so many economies went into negative interest rate territory. But again, there was only so far that bonds could fall. Today, that is different. I think on a valuation basis as well, it's quite interesting because if I look at the dividend yield or earnings yield that a company gives me at the moment, it's actually not that much different than a bond yield.
Sure.
And that's quite rare. The last time we saw bond yields and equity yields be this close was actually about 20 years ago. So,
was it?
Yeah.
So that's that equity risk premium, right?
Equity risk premium, that's right. So I think that's interesting too. So I think for investors, it can be really tempting at these times when equity markets are going gangbusters, bonds going not so well, that you look in the rearview mirror and you go, oh, equities are great, bonds are terrible. But I think actually on a forward-looking view, we actually ought to be more balanced in our assessment between equities and bonds.
You don't want that recency bias to cloud what is as you've said, a good investment. Treat it on its merits, right, looking forward.
Correct.
So to you, Chris Wilson, next, we'll go from that to a little bit like geopolitics and, I guess what's happening on a global perspective. While global economic trends dominated in 24, some of the key events like the conflict in the Middle East, potential trade wars under a new president, Mr. Trump, could play a larger role, obviously, in this year. I think it's could is now are. Yep. How do you expect these risks to impact global markets going forward? And could they shift the focus away from kind of, I guess, underlying macroeconomic trends that are favourable or not?
Yeah, absolutely. And, we've seen it. And as you say, this, the timeliness of doing this podcast a month or two after releasing the paper means some of the things that we thought may happen have actually happened already. And so,
How prescient.
Amazing. And who would have picked it for Trump? And actually, no, but what you have seen with Trump is, look, really quick escalations, but then de-escalations quite quickly on the tariffs as well. I mean, tariffs put inflationary pressure into the US economy. That's not good. We know the challenges that inflation in the US economy creates, weakens growth globally, which is a challenge. And then there's also the risk of the trade wars. So people then putting tariffs back on US goods going externally as well. And so overall, that's weaker or a negative outlook for overall growth. Looking at geopolitical, absolutely any time there's a war or a conflict globally, there's a human tragedy that underlies that. And, you have to acknowledge that, and, there's always the hope that those things resolve and come through. I think one thing you see with markets, though, is, look, those geopolitical concerns and risks have existed in markets, for eternity. They always exist, and, the issue that you're aware of today is to your recency bias comment, the thing you're most aware of now. I think if we look back at history of markets, there's always been something going on that creates those concerns. And absolutely, they escalate, and you'll have periods of heightened sensitivity. But and we expect to see that. And so absolutely, there's a chance that takes the narrative in markets from time to time. You see these risk-off type events. When Trump makes another statement or threatens another tariff, and you'll see markets react to that. And we've seen that at the start of this year. We've seen some really strong market reactions, over the first couple of months.
And do you think, I guess closer to home, I was going to say, markets climb a wall of worry, and you look back historically, but closer to home, do you think our Australasian companies, understand, or is it fully priced in some of those geopolitical risks to Kiwi or Australian companies' prices or values?
Yeah, look, I think there's absolute awareness of these things, right? The market will price those activities, and one of the advantages of an active management approach that we have is the ability to take positions of where we think the market hasn't priced those things accurately. We'll take positions relative to the market to add value to portfolios relative to just holding the index of stocks and moving with the overall market. So look, absolutely, and there's areas within portfolios where we will take positions where we think the market hasn't got quite it right. And that's where we seek to add value to the portfolios. And
turning, I guess, to that well, I was going to say elephant in the room. Trump, taxes, and tariffs. That's a key theme that you write about. Is President Trump and U.S. economic policy. There's proposed tariffs in Canada, Mexico, China. I think the Canadian and Mexican ones are now confirmed to come in as of when we're recording this. There's now an overnight talk about a Europe tariff now as well, which just seems to be thrown out left, right, and centre. How do you think these tariffs impact both US consumers, or how they will impact them, and markets in 2025?
So US consumers will be impacted by that price increase and the price pressure that tariffs put into the market. That inflation that goes in and a rise in interest rates then has a flow through. And, I think as our fixed interest team loves to say, where interest rates go, equity markets do tend to follow. And so, we'll see that flow through. So I think the challenge we'll see is, does he follow through on all of those statements? Do these, trade wars actually really take effect? And yes, those tariffs will take effect. How long do they stay on for? Do they back down? And those are the things we'll be watching.
So, Chris Di Leva, do you think the tariffs are purely a negotiating tactic, this art of the deal, sort of love and thirst for that? Or are they actually, tariffs we take it at face value that tariffs are needed or not?
I think where the market has got to is that they are largely a negotiating tool. We're not completely comfortable with that because that
you guys at your shop aren't comfortable. Yeah, right.
Yeah, just with taking that at face value, we think actually we've got to be a lot more open-minded on what they are, because if you look at Trump so far, everyone was really focused on what he was talking about on the campaign trail. A lot of what he's announced subsequently, if you look back, was not announced.
It wasn't?
On the campaign trail. Greenland. Panama Canal. These are things that aren't mentioned. So for us, with his policies, our view is that we have to keep an incredibly open mind, but also see them not just as risks, but also opportunities. And on the opportunities side, if we put tariffs aside for a moment, the deregulation side does actually have a lot of potential
and merit
as an earnings driver for companies. On the taxes front, I think the current assessment is that it's probably going to be a little bit harder than was initially anticipated in rolling out corporate tax cuts. So on the campaign trail, he talked about quite substantially lower rates. Now he's talking about maybe a 1% cut to
only 1% now.
Corporate tax rates. Yeah. So that was the huge upside surprise last time he was in. So we had a huge earnings boom the last time he was in because of two reasons. One, he cut taxes. Now, the easiest way to put more money in investor hands is to put less money in government hands through taxes. So that really worked well. He also had the repatriation of income. And when you repatriate income, a lot of companies go, oh, actually, we do have some income that we can repatriate. So that increased earnings per share as well. So we're probably not seeing the same element of those opportunities than what was thought on the campaign trail. Because if you look at the initial reaction from the market to when Trump's victory was kind of assured, you saw a really strong rally from markets. You saw financials.
Saw.
Yeah, and that was really around the deregulation theme. So financials, heavily regulated industry, deregulation tends to be good for them, more higher profits. But since then, the market's actually started to focus a little bit more on the negatives. I think the market itself is starting to rethink, are tariffs a negotiating tool? Because there's been a lot of flip-flop so far. They're on, they're off, they're delayed, they're not. The one key takeout that we can give to people is that at current valuation levels, there's not a lot of risk priced in at the moment. And political uncertainty is very, very high at the moment. So that's why we talk about things like bonds. That's why we have a far more balanced view of where equity markets can go relative to bond markets going forward, because of that starting valuation, but also because of the level of uncertainty that investors will need to digest.
I think I've seen it floating around a few times, a bit of a well-known story of now President Trump, I think 20 or 30 years ago, bidding for a famous piano, a concert pianist's piece of equipment, and was outbid by a Japanese, either company for it or individual. And then the next day or next week, he was on television again. He wasn't in politics then, but advocating for blanket tariffs on Japan. So this is not a new thing that he's been doing, is what I've been reading. In terms of the year ahead for a different kind of asset class, now you guys help us with Australasian equities into corporate bonds, but where do you guys, I guess I'm quite keen to get your perspective on where do you see private markets kind of going? Private credit seems to be all in vogue. It's growing exponentially. Given the emerging growth of that in kind of VC or venture capital in NZ, and there's a relatively low allocation, compared to, I guess in funds and super schemes compared to like things like Aussie. Chris Wilson, do you think this year will be a turning point here for anything private related?
I actually think it will be. And as you say, look, it's been a nascent growth area for the last few years. I think what we're starting to see in New Zealand is some real strong support from the government, towards the tail end of last year. A lot of work being done on, are there settings within the KiwiSaver that can be looked at to support the investment of private markets in New Zealand? You kind of come back to your initial comment on the exposure of private markets in New Zealand. Like New Zealand, it's very, very low. I think overall market, a tiny number. Australia gets towards 18%. You get into the US public pension schemes, you're up around 34%. New Zealand is just not there.
Why do you think we don't?
Look, it's a new sector. It's small. It's growing. It's like, how do we create a structure for these investments?
It's relatively new for us. You mean
new for us, but the size of the market is not as large. And it's about the pension fund. And look, our industry, KiwiSaver, is a new industry for us. The scale of that relative to the US pension plan schemes, the European schemes, is quite immature as well. But you look at private markets, and that's something that Superfund has been investing into for many, many years now. So look, there's pathways of us into that sector, and we see it as an opportunity set into New Zealand. The NZX is doing a lot to try get more public listings into the New Zealand market. We haven't seen a lot of listings in the New Zealand market.
Critical to what you guys
lately.
do for us.
But, which is critical what we do as a listed manager. But that's one way of raising capital. And so private markets, and so there's opportunities that don't go onto the public markets that private investment allows you to assess. And so, we see a great opportunity to assess some of those opportunities. And I think we will continue to see people developing opportunities in the space. And look, some people have dipped a toe in the water, and there are some great, companies working in the VC space in New Zealand. Ice House, a group that we're across, and it's pretty well known in the sector, have done a good job of building out the community and the network, of investment. And I think we'll continue to see that develop as the industry grows and continues to develop. And
just on the flip side, quickly, is I guess any key risks you'd see to delving more into that area?
Yeah, there are. I mean, the liquidity is just different. A public market, you're getting a stock take on your price every single day, and
minutes,
all throughout the day as well.
Yeah.
And with futures overnight as well. And so, whereas with some private markets, look, valuation's important. How are you considering valuation? The unit holder equity with KiwiSaver, people are coming and going into the funds every day.
Yes.
Into the investment classes, and effectively, you need to make sure that when someone's leaving, they're getting fair value for what they're exiting if the asset that they're actually buying or selling hasn't had a revaluation through that period. And so, there's some things to consider. But look, this is not an issue that hasn't been resolved in offshore markets. New Zealand is not unique in having a superannuation scheme and structure. That happens all around the world. So look, these problems can be surmounted.
Yeah, and look, just to add to that, on the opportunities front, there is a massive global trend that we are missing out on over here.
The trend to private, or the
the move to private equity in particular in the US has developed considerably. So if you look at measures on number of listed companies in the US, there's used to be a popular stock index in the 1980s and 90s called the Wiltshire 5000. It's not the Wiltshire 5000 anymore because they can't find 5,000 companies. So the amount of listed companies have fallen. The amount of private equity-backed companies has increased. What that has meant is in a company's life cycle, they are listing later.
Yeah.
And that means that more value is getting captured by the private markets and the public markets. And you can see that if you just look through the top 10 stocks in the US, they actually haven't been listed all that long. So the time of getting to, $100 million revenue and listing on the stock market, those days are gone because there is a private equity ecosystem, particularly in the US, that will continue to support them with capital, patient capital, not after quarterly dividends, not worried about a day-to-day share price, really long-term capital that will support them to grow. And when they reach a point of relative maturity, then they'll list. But as you know, in getting to the point of relative maturity, that is where a lot of value is created. So that's, I think from the opportunity perspective, it is getting to a size where we really can't ignore it anymore, because actually it's a market size that it really does not make sense. When you look at the small amount of listed companies worldwide, it does not really make sense to ignore private markets. There is the issues, as Chris mentioned, about illiquidity, but obviously not insurmountable.
I mean, whether they're listed or private, companies still need access to debt and equity to do things. And I think private equity probably suffers from a little bit of the flow-on image issues from the 80s and 90s, where you think it's like the famous barbarians at the gate and stripping RJR and Nabisco or whatever it was, just stripping things for parts, as opposed to patient capital, right?
Yeah.
And so let's go from private capital and equity and debt and all things private. Let's go to one of your other key themes. I guess it's a short, sharp question. Chris Di Leva, to you, has inflation sustainably returned to 2%?
So New Zealand's a little bit different than the global picture, right?
Yeah.
So we have had an economy that has undoubtedly responded to higher interest rates. We see it when we walk down the street. We see it when we look at house prices, right? They're still relatively flat. They've stopped falling, but they haven't started ascending again yet. So monetary policy has worked in New Zealand, and certainly relative to the US, we're getting close to 2 at about 2. There are long-term inflationary pressures that we do worry about. So governments keep running deficits, which means that they need to issue more bonds. There's a lot of bonds for the market to absorb. Just a lot of debt out there, which tends to long-term be inflationary. Demographics worldwide, that could lead to inflation running a little bit more to the upside. Also, inflation begets more inflation. So, if you look prior to COVID, you had a generation of companies that would never even try put through a price rise because it just never worked.
Yeah.
But actually we've seen, and sometimes all too often, particularly when I go to the coffee shop now, that you see the pricing
has been passed
activity.
through.
Yeah. The one real concern at the moment globally is that inflation expectations in the US have started to really become a little bit unanchored. And that's amazing when you consider in 2022, we had really high inflation numbers, but people believe that it was relatively transitory. I know that was a word that got a bit of flack at the time. But so it's quite concerning at the moment that when we get the 2-year and 10-year, especially, inflation expectations out of the US, that I think they've hit the highest levels in over 2 decades.
Yeah.
So that's a little concern because, again, there is a behavioural element to inflation. But I think the key thing for markets is that it is within, in most developed economies, acceptable bands now.
Yeah.
And if we contrast that to 2 or 3 years ago, we just didn't know how high it was going to keep going.
Unanchored.
Yeah. Or just how quickly it would fall. So most of the work is done there. So I think most of the controversy from a market perspective, I think it becomes less and less of a headline going forward.
Okay, let's dive into our last question before we get into the wrap up. I guess an interesting theme, that we've been talking about on multiple podcasts is or 2 themes: the climate impact on markets and investing, and also AI. You put them together, I guess, they're quite a critical coexistence, those 2 things. What AI-related companies are doing and asking for from the power grid, as a massive ramp-up? What are your guys' thoughts and how those 2 things can coexist? Is one going to win and take precedent over the other or not?
Yeah, look, and so, to sort of formulate what's the issue is, just the computer and the data usage and the energy usage that, jumping on ChatGPT and doing a request does, right? And so fundamentally, look, there is a huge power drain. And so you then come to, okay, how are you generating energy and how are you supporting that? And you look at the US as an example where a lot of these data centers, a lot of this draw is coming from, and they've only got 20% of renewables. And so actually the role of renewables is really, really important. One of the great things we see, and I think this is where customer-led demand drives the industry, is actually a lot of the big data center providers and a lot of the big providers are now going 100% renewable energy for their data centers. And again, that's customer-led. And so, it's the example of it's not one or the other. I think these things will coexist and go hand in hand. And so the customer expectations will drive the data centers and the providers to focus on how they're sourcing the energy and how they're utilising.
We had an AI-related event for clients the other night, and our Chief Data Analytics Officer, Travis Barker, was saying he'd looked at our local ecosystem, for where New Zealand could excel and play its part in it. And one of them was obviously building software on top of the stack, right? Applications, how we use it all. But he also focused on our power base and the renewable energy. So I just wanted the final question I wanted to pose was do you, from the companies you follow related to power and the utilities, do you see it as somewhere they can win or play into AI related power or not?
Yeah, so the New Zealand gentailers, as they're called, have actually done a really good job of starting to decarbonise our electricity grid. So Contact Energy is a really good example. The Tahara development that they've done gives us more baseload energy. Key issue with renewables is that sometimes the wind doesn't blow.
Sun doesn't shine.
We don't have that issue in Wellington, which is great. And sometimes the sun doesn't shine, which we sometimes have that issue in Wellington. So this baseload power is really helping us forward. So I think actually the companies we work with, they are really innovative, and there is definitely more capacity in New Zealand or more potential in New Zealand to scale up, do more geothermal, to step into that void. And we are in a great position because if we look at renewable energy globally, there's been so many false starts. Now, if I look back 5 or 6 years ago, offshore wind was the big development point. And, oh my gosh, you got to see these things. They're huge.
Yeah.
They're just absolutely huge. But what they found is actually when you put a wind turbine out at sea, the sea can be a cruel mistress. It's salty.
Love that
absolutely,
wording.
So the depreciation on these assets, turned out to be higher than people expected, but also the test for solar and wind has actually been interest rates. Because if you look at them, we're really starting to get good cut through with wind projects, but partly debt finance, so quite sensitive to movements in interest rates, and also for solar on roofs. But the issue there is, as soon as interest rates went up, because a lot of these are finance, the model kind of didn't really work. So we've seen a lot of false starts offshore with renewables. And I actually think in New Zealand, we've actually been doing it quite a long time. We've got really good hydro electricity. We've got really good geothermal. So that is a place that we can excel. I think it's a great idea. And more importantly, I actually think we've got great companies in New Zealand who know how to build these projects, know how to get the experts in, and make a real difference.
Well, if there's any listeners out there who are weighing up where their next gigawatt or multiple hundreds of megawatt data centres can be, maybe look at little old New Zealand. Right, let's wrap up. So one last question I like to ask of all my guests, and we're going to go to you, Mr. Di Leva, first. Is there something you're currently reading, watching or listening to that you'd recommend our listeners could look at?
Yes, I'm a big biography fan, and I think one of the best biographers in the world is a guy called Walter Isaacson.
Agree.
He's done a biography on Elon Musk, who isn't everyone's cup of tea, but I think everyone can agree has led a pretty interesting life so far on pretty much every front you can imagine. Another one Walter Isaacson's actually done is Leonardo da Vinci's biography.
Did he?
And Leonardo da Vinci, he didn't get to do any interviews, unfortunately, for the for the Leonardo da Vinci one. Yeah. But it's so his mind and the curiosity that he exhibited towards coming up with solutions for defence, walking on water.
Wow.
Obviously art, but also flying machines. It's just unbelievable. And, the key message that you get from there is just around, if you're curious, actually, you can achieve quite a bit. So that is another one that I'd really recommend.
Because he's done, he says Da Vinci, Musk, he also did Jobs as auto.
I think
either biography or autobiography it might have been before he passed away. But there's a thread of innovation all through there, isn't there?
Yeah, definitely.
And Mr. Wilson, what's your recommendation?
So I've got a book this time for you,
literature.
Nigel.
Okay,
and but no, it's almost called a bit of self-help, self-life book. So it's called The 5 Types of Wealth. By Sahil Bloom.
Tell us more.
Look, and it's interesting there. We talk a lot about financial markets. We talk about a lot of growth and investments, and podcast investment focus. But this book is really about that is one type of wealth. But actually, as you think about your personal journey in life, there's a lot of other things that are important that you need to consider. Time with family, your physical well-being, financial wealth and independence, and they're all they're all symbiotic. You can't just focus on one at the cost of others.
Balance.
And and really good use of charts and kind of anecdotes to explain the story and rationale. And a few of them really strike home. And I'll use one example. Just a great graph of how much time will you spend with your parents.
Oh gosh, don't do it.
Yeah, heartbreaking, because you look at it and that period, and I have two young children, 8 and 10, and I'm great. I'm at the high part of the graph. And then I look at my age in that graph and think of my parents, and I'm at the low end of the graph, and that thing drives away, to be honest, when you go past 20.
Yeah.
And so it's a really good reminder. It's a great book to just ground you on actually what's important, think about, overall what you do, and it sort of makes getting up every day just a little bit easier.
Okay, I'm going to go get that. My quick one was Same as Ever by Morgan Housel. I think it's very similar to kind of what you were describing. Small chapters, 4 or 5 pages on the things that actually matter, like compounding. Like, don't try and win everything in your career in the first week. It's kind of like, just apply yourself. So there's some, look at us. It's like a Borders book club. So I'm going to call the Chris competition, it's a draw. That way I get out of it, and you guys on the way back to the office can work out if you agree with that decision.
I think it just opens the door. We're going to have to come back for a rematch.
Any time. It's like a boxing fight, right? Like, we're going to have a rematch. We're pulling the rematch clause.
This feels like one of those fixed boxing matches.
I think they're all like that.
Check the score, guys. All right, well, thank you both for your time and expertise today. It's been an absolute pleasure having you on the show. I hope it's come through in terms of the listeners that we get on like a house on fire here. Keep an eye on those local and Aussie companies and bonds for us. And we'll see you, our very valued listeners, on the next ASB Investment Podcast. Until then, it's happy investing and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.